If you do this, you could lose 90% of your future money, not because of a scam, not because the market crashed, but because of one simple mistake, the kind that hides in plain sight. Imagine spending years saving, investing, being disciplined, only to watch your entire compounding journey collapse like a house of cards. And here's the scary part. Most people make this mistake without even realizing it. It doesn't happen in one dramatic moment. It creeps in slowly, and by the time you notice, the damage is done. Stay with me, because this one decision could be the reason you never reach financial freedom. Compounding is simple, but it's not easy. It's the process where your money earns returns, and then those returns earn returns, again and again. Time and consistency are its secret ingredients. The longer you stay in the game, the more powerful it gets, like a snowball rolling down a mountain, growing faster with every turn. But here's the catch. Compounding is powerful, yet extremely fragile. One wrong move, just one, and the entire effect can collapse. And the worst part? The mistake that destroys it usually isn't technical. It's emotional. It comes from panic, fear, impatience, and it's made in moments when logic takes a back seat. In a minute, I'll reveal exactly what this mistake is. But first, you need to understand why it ruins everything you've worked so hard to build. Compounding is one of the most powerful forces in the world of money, yet it's also one of the most misunderstood. Most people assume it's just about earning interest or seeing returns stack up over time, but that's just scratching the surface. Real compounding is built on two simple but non-negotiable elements: time and consistency. Think of it like planting a tree. You water it every day, give it sunlight, protect it from harm, and for weeks, maybe even months, it looks like nothing is happening. But beneath the surface, the roots are growing. And one day, that little seed turns into a massive tree. That's exactly how wealth grows. Quietly, slowly, and then suddenly. But here's the danger. Most people don't have the patience to wait. They expect results too soon. They plant the seed, water it for a few weeks, and when nothing magical happens, they dig it up and try somewhere else. And by doing that, they destroy the very magic they were trying to build. You see, compounding is like pushing a giant flywheel. At first, it barely moves. You push again, and it creaks forward just an inch. Again, a little faster. Over time, the momentum builds, and eventually it starts spinning so fast, you don't even have to push anymore. That's the nature of compounding, but it only rewards the ones who keep pushing, those who don't quit early. And unfortunately, that's where most people fail. They break the cycle right before the breakthrough. They give up in year 3 when the magic usually begins in year 7. They get distracted, they get scared, they make impulsive moves like pulling out money too early or skipping contributions. They switch strategies, they follow trends, and all of that resets the clock. They think it's just one small change, but that single change disrupts the entire process. It's like quitting your workout just before your body starts transforming, or giving up on a business idea right before your first big sale. The real compounding rewards happen later, way later than people expect. And the worst part? The mistake that kills compounding isn't usually a financial one. It's emotional. It comes from impatience, fear, greed, or even boredom. You get scared when the market dips. You feel tempted when everyone's chasing the next hot stock. You lose hope when results don't come fast enough. And in those moments, you act, not out of logic, but out of emotion. And just like that, the chain is broken. All the effort, the discipline, the sacrifices, wasted. That's why I said earlier, this mistake isn't technical. It's not about using the wrong app or picking the wrong stock. It's about mindset, it's behavioral, it's psychological. Let me give you a simple analogy. Imagine a kid baking a cake. The instructions say to keep it in the oven for 30 minutes. But after 10 minutes, the kid opens the oven, sees the cake still looks raw, and throws it away. He thinks he failed, but the cake wasn't bad, it just needed more time. That's what compounding needs, time in the oven. And too many people ruin it by opening the door too early. They check their investments every day. They obsess over numbers. They compare themselves to others. And that impatience leads to doubt. That doubt leads to action, and that action resets the process. Compounding is slow to start. It doesn't give you fireworks in the first year, or even in the second or third. But if you stick with it, if you stay patient, the results become exponential. The money begins to grow faster than you thought possible. But only if you resist the urge to interrupt it. That's why compounding is a test, not of intelligence, but of temperament. And now that you understand the fragile beauty of this process, it's time to talk about the one mistake that destroys it all. So what is this mistake? The one that silently kills your compounding journey without warning? It's not bad luck. It's not a market crash. It's not even about earning less. It's breaking the chain. The one mistake that destroys decades of financial progress is this: interrupting the compounding process, either by pulling your money out too soon, skipping contributions, or stopping altogether when things get uncertain. Think about that for a second. The power of compounding isn't in the money you invest, it's in the time you let it grow, uninterrupted. But most people don't treat it that way. They treat their investments like a savings account. Pull money out when things get tight, pause when the market dips, skip a few months because life got busy. And that's where it all falls apart. Not because they didn't know what to do, but because they couldn't stay the course. Let's say you're investing consistently, letting time and discipline do the heavy lifting. But then the market crashes. The media screams recession. Your portfolio drops 15%, 20%, maybe even more. And you think, I better stop before I lose everything. So you pull out. You feel safe in the moment. But what you've actually done is press the emergency brake on a train that was just gaining momentum. That single move didn't just protect your money, it robbed your future. The truth is, people don't ruin compounding with one giant blunder. They ruin it slowly, with small, emotionally driven decisions that add up over time. And the mistake feels smart when you're making it. You tell yourself, I'm just being cautious, or I'll get back in when things are stable, or worse, I'll start again next year. But compounding doesn't forgive pauses. It doesn't care about your timing. It only works when it's left alone. Even the smartest investors in the world, people with MBAs, analysts, fund managers, they've all made this mistake because it's not a technical error. It's an emotional one. It doesn't happen on spreadsheets. It happens in your gut. That anxious moment when you see red numbers, that urge to act, that whisper in your head that says, better safe than sorry. And just like that, you cut the engine of the most powerful financial force working in your favor. And it's not just fear. Some people interrupt compounding for reasons that sound positive, like taking profits too early. Imagine someone who invested $20,000 in a great index fund, watched it grow to $35,000, and said, that's enough. I'm happy with this gain. They cash out thinking they've won, but they've just left hundreds of thousands on the table. Why? Because they judged the journey too early. They forgot that compounding doesn't show its full magic in years 1 through 5. It shows it in years 15 through 30. The problem is, the pain of short-term loss feels louder than the reward of long-term gain. That's human nature. But compounding doesn't respond to your feelings. It's not emotional, it's mathematical. And once interrupted, the damage isn't just the money you pulled out, it's the decades of growth you can never get back. That's the real tragedy. Not what you lose today, but what you unknowingly lose tomorrow. So remember this, the biggest threat to your compounding journey isn't the stock market, inflation, or interest rates. It's you, your decisions, your impatience, your fear. That single moment when you break the chain, thinking you're doing the right thing, that's the exact moment you might be destroying your future wealth. Now that you know the mistake, the next step is to understand the damage it actually causes. Because hearing about it is one thing. Seeing the numbers, the consequences, the what could have been, that's when it really hits home. Let's visualize the damage. Imagine two friends, Jason and Mark. Both are 25 years old. Both start investing $500 a month into a simple S&P 500 index fund. They do this for 10 years. But here's where things take a turn. At age 35, Jason continues investing without ever stopping through good markets and bad. Mark, on the other hand, gets nervous during a downturn. He decides to pause. He tells himself he'll get back in later, but later never really comes. He ends up skipping the next 10 years of contributions, a full decade lost. Fast forward to age 65. Jason, the consistent one, has nearly $1.2 million. Mark, he ends up with just around $600,000. That's half the money, just because he stopped during what felt like a temporary pause. And the most painful part? Mark actually contributed almost the same amount of money in total, but Jason let time do its job. Mark tried to outsmart it, and he paid the price. Or take another example, one that hurts even more. Say you invested a lump sum of $10,000 in the market and left it untouched for 30 years. The market averages around 8% annually. That $10,000 grows to almost $100,000. But what if you missed just the 10 best days in the market over those 30 years? You'd have only $50,000. That's right. Missing just 10 days out of 10,950 trading days cuts your returns in half. Now ask yourself, when are the best days most likely to happen? Almost always right after the worst ones. So if you panic and pull out during market crashes, you're almost guaranteed to miss the rebound. It's like jumping off a roller coaster at the bottom of the dip, just before it shoots upward. We tend to think missing a few months or years won't matter. But compounding doesn't work linearly. It works exponentially. Missing early years means missing the snowball effect entirely. Missing later years means losing out on the biggest gains. And both are deadly. Let's break it down even more simply. Let's say Emma invests $200 a month from age 20 to 30, then stops. Just 10 years of investing. Her friend Olivia waits until age 30 to start, but invests $200 a month all the way until age 60, 30 years of investing. Who ends up with more? Surprisingly, Emma wins. Even though she only contributed for a decade, her early start gave compounding more time to work. Olivia contributed 3 times more money, but got less in return. That's the brutal beauty of compounding. It's not just about how much you invest, it's about how long you let it grow. Now think about what happens when people interrupt that growth, even temporarily. Let's say someone takes a break from investing for just 1 year during a recession. They stop contributing, maybe even pull money out to stay safe. But in that 1 year, the market rebounds by 25%. Now they've missed the biggest recovery, and even if they start again next year, the loss is permanent. That one emotional move just set them back by decades. And here's the hidden cost. When you break the compounding chain, it doesn't just slow you down, it forces you to invest more later to catch up. You go from needing to invest $500 a month to needing $1,200 a month to end up in the same place. And most people won't do that. So instead, they settle for a smaller future. Less freedom, less choice, less wealth. All because of one mistake. It's like planting a tree and chopping it down when the leaves fall off. Sure, it looked like it was dying, but you didn't give it the seasons it needed to grow. Compounding is the same. It needs time, seasons, patience. Interrupt it, and you reset the clock. So if you're someone who's already made this mistake, don't panic. The damage is done, yes. But what matters now is that you don't make it again, because the second interruption can be even more damaging than the first. So how do you avoid this mistake, the one that quietly destroys the compounding journey for millions? It starts with one simple mindset shift. Treat your investment plan like a non-negotiable habit, not a flexible option. Think of it like brushing your teeth. You don't brush only when it's convenient or when your schedule's perfect. You just do it, because the cost of skipping isn't worth it. Your investment habit deserves the same level of consistency and seriousness. First, automate everything. Your contributions, your transfers, your investments. Don't leave it up to discipline or memory. Set up automatic deductions from your checking account to your investment account, and let it run in the background of your life. This removes the temptation to pause or delay. The less friction, the fewer excuses. Second, build a simple plan and stick to it. You don't need to chase the hottest stocks, predict the market, or outsmart the economy. In fact, trying to do so increases your risk of making emotional decisions. Choose a diversified index fund. Decide how much you can afford to invest monthly and stick with it through thick and thin. That's the real superpower. Consistency, not complexity. Third, prepare for the dips. They're coming. Markets go up and down. Recessions happen. Headlines will scream. But here's what smart investors do. They keep going. They don't flinch. They treat downturns like a discount sale, not a disaster. So instead of reacting emotionally when the market drops, remind yourself this is where the wealth is made. Not by avoiding volatility, but by surviving it without breaking the chain. Fourth, protect your investing habit by separating it from your emotions. That means don't check your portfolio every day. Don't obsess over daily gains or losses. You don't dig up a seed every morning to see if it's growing. You water it and walk away. Let your investments do the same. Trust the process. And if you ever feel tempted to pull out or pause, ask yourself this: am I making this decision based on fear or strategy? Because if fear is running the show, chances are you're about to interrupt something powerful and costly. Instead, zoom out. Look at your 20-year goal, your freedom, your dream future. That's what's on the line. Lastly, surround yourself with the right inputs. Unfollow financial fearmongers. Turn off panic-driven news. Read long-term thinkers. And most importantly, remind yourself of your why. Why are you investing? Is it for freedom? For your family? For peace of mind? That why will be your anchor when emotions try to take over. Look, you don't need to be perfect. You just need to be predictable. One good decision, repeated consistently, beats 100 clever moves made inconsistently. That's how compounding rewards you. Not with applause, but with quiet, unstoppable growth. Compounding doesn't demand brilliance. It doesn't care if you're a finance expert or if you missed a few steps along the way. All it asks is this: don't break the chain. Just keep going. One contribution at a time. 1 month at a time. 1 year at a time. Because time is your greatest ally, but only if you let it do its job. The truth is, most people don't fail because they never started. They fail because they started and then stopped. They let fear, noise, or impatience push them off the path. And by the time they realize what they've lost, it's already too late. But that won't be you, because now you know, avoiding just one mistake, interrupting compounding, might be the only thing standing between you and true financial freedom. It's not about being perfect. It's about being consistent, quiet, patient, relentless. So ask yourself honestly, are you accidentally sabotaging your own compounding journey? If this made you reflect, if it shifted something inside you, then do one thing. Hit subscribe and join the tribe of long-term thinkers. We're not here for hype. We're here to build wealth that lasts. No shortcuts, no noise. Just smart, powerful steps forward. And remember, when in doubt, don't stop the compounding.